Okay, it's 2 o'clock. I think it's time to get started. For those of you on this webcast, welcome. Thank you for your time and attention. Very pleased to host an event with Ed Yardeni, a very prominent and influential Wall Street strategist, as everybody knows. So the structure of the event today is really going to be as follows. I'm just going to take everybody through a few introductory slides on our firm. I'm going to introduce Ed. And then we're going to talk about Ed's market outlook. The structure that the structure of the event or the Q&A is going to really be as follows. We're going to ask Ed about his market outlook. We're going to talk about monetary policy. We're going to pivot to fiscal policy, and then we're going to talk a little bit about geopolitics, including Europe. So if you can see on the screen, market outlook with Ed Yardeni. We have our standard disclaimer. You would just go to our website and hamiltonetfs.com/legal. Just a quick background, there's an awful lot of people on this call, but assuming some of you are not 100% familiar with us, just some quick takeaways. First, we're financial sector specialists. We have a portfolio management team with over 60 years of experience in the sector. We offer 7 financials ETFs, including 3 that are actively managed. We also have 2 higher yielding multi-sector covered call ETFs, i.e. non-financials. We are almost certainly the fastest growing ETF manager in the country. Our AUM is 1.5 billion across 9 ETFs. Our AUM has tripled in the last 12 months. It's gone up nearly 60% since November. And we are now the #2 provider of Canadian bank ETFs with over $1 billion of AUM in just 2 ETFs. In terms of last year, was very eventful. 2021 in review, we had the top performing Canadian bank ETF, the Hamilton Enhanced Canadian Bank ETF, ticker HCAL. We had the second best performing Canadian bank ETF, the Hamilton Canadian Bank Mean Reversion Index ETF, ticker HCA. HCAL, which we like to call it, outperformed equal weight and cover calls by about 12% and 21% respectively. Our active mandates continue to thrive. Our Hamilton Global Financials ETF, ticker HFG, outperformed all global financial indices and competitor ETFs by between 300 to 500 basis points. I think we have the only fintech ETF globally that actually makes money, the Hamilton Financials Innovation ETF, ticker HFT. It is very, very far ahead of any other fintech ETF that we're aware of globally. And then we have the Hamilton US Mid Small Cap Financials ETF, ticker HUM, which was not only the best performing financials ETF in Canada last year, but according to Morningstar was among the top 10 of all ETFs in Canada. So just some quick points in terms of recent launches. We've had some very successful launches of late. We had 2 enhanced yield multi-sector ETFs, the Hamilton Enhanced Multi-Sector Cover Call ETF, ticker HDIV, which has an 8% plus yield paid monthly. It has a sector mix broadly similar to the TSX 60. And that was launched in July of 2021. It has about 180 million in it. Then more recently, we launched a sister fund to it, the Hamilton Enhanced US Covered Call ETF, ticker HYLD, basically the same structure as HDIV, but it has almost a 10% yield paid monthly. And where HDIV seeks to broadly match the TSX 60, HYLD seeks to match the S&P 500. This was launched in February of 2020 and has about 85 million in it already. And then we launched a financials ETF for enhanced growth and yield, the Hamilton Enhanced Canadian Financials ETF, ticker HFIN. It is about a 5.5% yield paid monthly. It's basically an equal weight portfolio of the top 12 Canadian financials with a modest amount of leverage. In terms of just giving you some quick switch ideas, HCAL, which was the top performing Canadian bank ETF in 2021, has a high return and similar volatility to your average big 6 bank. So if you own one of the big 6 banks, HCAL, which has a little bit of leverage in it, only 25%, has a yield of about 5.6. You could switch any Canadian bank, get a higher yield, hopefully a higher potential return over the long term, and benefit from that. And of course, because it's the top performing Canadian bank ETF, you could substitute out of any other Canadian bank ETF for this one. HFIN, which is its sister fund, isn't Canadian banks, it's banks and insurers. Same principle, except for this one is the top 12 Canadian financials ETFs. the top 12 Canadian financials, excuse me, and it has about a 5.5% yield. So if you own HFIN or any other Canadian insurer or Canadian financials ETF, we think this would be a very compelling substitute. And then moving on to HDIV, or Hamilton Enhanced Multi-Sector Canadian ETF, equal weight portfolio of sector cover call ETFs with a little bit of leverage. It's a higher yielding alternative to the TSX 60. You can see the index that it's based off of multiplied by 1.25. Despite the fact it has higher yield and it's a portfolio of cover call ETFs, the index has historical outperformance relative to the TSX 60. A switch idea, buying HDIV, selling any Canadian equity ETF and or sector cover call ETF is actually a very good fund. And then HYLD, exact same principle except for the US. Here we have about a 9.8% yield. There's HYLD and CAD, which is hedged, and HYLD.U, which is US dollar unhedged. Again, any US equity or sector call ETF would be a logical thing to sell in favor of HYLD. And then we're going to talk about the financials. We actually have a very unique, to the best of my knowledge, it's the only ETF, at least in North America, that invests in the US mid and small cap financials. That's a great category. It's had double the return of the large cap financials over the last 25 years. This ETF has been very, very successful. It's materially outperformed the large caps. It was, as I said earlier, it was in the top 10 performing ETFs in all of Canada last year, top performing US financials ETF, top performing financials ETF. The great thing about the US mid-cap financial sector is it's so big and so diverse and so many companies that you can really customize your portfolio to good high-performing companies, but also those that are in high GDP population growth areas and MSAs. And GDP growth obviously is an important variable when you're thinking about the financials. And it really probably is the time to start thinking about financial innovation and fintech. We have the top performing fintech ETF in 2021. We actually have a 10% annualized return, while almost every other competitor ETF is deep in the red. This is an actively managed blue chip portfolio of financials focused on innovation, but with higher earnings growth and higher ROE. Really should have 3 to 5% in your financials allocation. Here you can see on a chart, the dark burgundy is our funds since the beginning of the year, or since December of 2020, I should say, and huge downdrafts for some of the more prominent fintech ETFs that you read about or see talked about on CNBC pretty much every week. And then lastly, before I introduce Ed, I just want to make a quick comment about ETF liquidity. As everybody knows, ETFs have market makers. They create on-demand liquidity. So our ETFs are highly liquid, so you can ignore what you see in average daily volume. You need to know really two things about trading ETFs, whether it's Canada or the US. You need to know two things. Number one, you really shouldn't trade between 9:30 and 9:40. So shouldn't trade before the close and before the open. So best execution between 9:40 and 3:50. And if you want to buy or sell, you put in a limit order. Do not do market orders, do limit orders. And after that, you are good to go on everything. So I wanted to introduce Ed, who probably doesn't really need any introduction, but let me try anyways. So Ed is the president of Yardeni Research. He's been a prominent strategist for about 40 years, held positions at the Federal Reserve Board, US Treasury, and has served as chief investment strategist at Oak Associates, Prudential Equity Group, and Deutsche Bank. I actually would point out that Ed has a book called Predicting the Markets. It's available on Amazon. And here I'm going to speak extemporaneously. We've been subscribing to Ed's services for many, many years, most of the history of our firm. And it's an excellent service. We are big fans. We've been trying to work with Ed for a while, but unfortunately the pandemic got in the way, so we decided to do this webcast. But if you go to yardeni.com, you can get a 4-week complimentary trial of Yardeni Research. There's an excellent daily update. He does a webcast once a week. And he also, by the way, includes some pretty good movie reviews. So with that, I'm going to stop sharing, and I'm going to thank Ed for joining us.
Thank you.
And welcome.
Thank you very much.
So as I mentioned, this Q&A, we're really going to try to follow or address sort of 4 topics actually. Ed's market outlook. We want to talk a little bit about monetary policy because It is so prominent right now, certainly in the financial media and people wondering about the yield curve. Fiscal policy is very, very important to the financial markets. So we're going to ask Ed some questions about fiscal policy and regulation. And then we're going to try to touch on geopolitics, and then we'll try to conclude. We're going to try to stay on schedule. So in terms of your general market outlook, Ed, in the past several years, you and your team have correctly advised investors that we're in a long-term secular bull market, and you refer to the sort of semi-frequent sell-offs as panic attacks. And just last week, you wrote that we're still in a bull market, and you suggested that maybe March 8th was the low. Can you talk about just generally why you remain bullish, and then maybe talk a little bit about your targets?
Well, I think the outlook remains quite positive for earnings. Of course, much will depend on the economy. Economic growth looks like it is slowing down. We're looking for real GDP to increase 2% per quarter at an annual rate this year in the United States. But at the same time, like everybody else, we've raised our outlook for inflation, and it certainly looks like it's going to be higher for longer inflation. If I had to put numbers on it, I would say 6 to 7% at an annual rate is where I think the inflation rate will peak during the first half of the year. And then by the second half of the year, I think we can get it down to 4 to 5%. And then next year down to 3 to 4%, which still remains above the Fed's 2% target. But I think the Fed is looking for some inflection point in inflation. They'd like to see the inflation rate coming down. And I think it could come down later this year as a result of consumer durables inflation coming down. The offset will be some rent inflation. But all in all, it's an economy that's growing with higher inflation, and stocks are a good inflation hedge. Revenues go up with inflation, and earnings also go up with inflation, as long as profit margins stay relatively stable. And that's, I guess, the controversial point of our outlook, is we think that companies will continue to be able to pass through their cost increases into prices. And so profit margins are likely to stay near record highs and relatively stable. So earnings are looking pretty good. The big volatility that we've seen has been on the valuation multiple. And it looks as though it's going to remain quite volatile, given the uncertainty about just how high the Fed's going to go and what's going on the geopolitical side. So I think we're looking at a very volatile market this year, much more volatile than we've had in quite some time. But once we kind of get into 2023, I think some of that volatility will dissipate, because a lot of these issues will be resolved. And I think the outlook is for continued growth. The risk to this, obviously, is a recession. And before the Ukraine war, I would have said 15% risk of a recession this year. Next year, now I'd say it's more like 30%. So we're watching out for a recession. But right now, our optimistic outlook for the economy overall is reflected in our stock market outlook.
So one concept that you've introduced in your writing every week, and you have a piece where you put out which tracks all of the panic attacks, I think since 2009, if I'm not mistaken. Yes. So if you had to think about the next, say, 12 to 18 months, are there anything that you think would be, any particular things that you think are likely to cause sort of short-term corrections within this broader bull market?
Well, you're right. We've been kind of keeping a diary, a logbook of panic attacks. Some of them are actual corrections of 10 to 20% in this bull market. Obviously, we had something that, technically speaking, looked like a bear market in 2020, but it just didn't last very long. I think it lasted all of 33 days. And so we kind of view that more as a panic attack than the end of the bull market that started in 2009. So we're up to 74 panic attacks by our counts. And at the beginning of this year, we had 73, which was related to a taper tantrum in the stock market and in the bond market. And then, of course, with the invasion of Ukraine by Russia on February 24th, that continued to unsettle the market. All of that lasted at about 64 days and took the S&P 500 down by 13%. Then we recovered by 11%. Now we're giving it back because of the volatility and because people are concerned about the Fed becoming more hawkish. Doesn't look like there's any doves left at the Fed. And just yesterday, we saw Fed Governor Lael Brainard, who is known to be a dove, squawk like a hawk. I mean, she definitely came out very strong on the idea that the Fed is going to have to increase interest rates and run off the balance sheet because inflation is a real serious problem. So we're already kind of seeing what's going to be continuing to hold the market back, and that is a perception that the Fed is hawkish. Question is, how hawkish are they going to really be? I don't think they're going to do what Volcker did in the late 70s and let interest rates go to whatever level it took to bring inflation down. And he knew that would cause a recession, and he knew that the sure way to bring inflation down is to cause a recession. I think this Fed is still hoping that they can raise interest rates just enough to slow demand down, to bring it into equilibrium with supply, bring inflationary pressures down, and have that all lead to a soft landing. I hope they get it right. I'm not convinced that they're going to get too aggressive to the point of actually causing a recession. But as I said, it's not a foregone conclusion that we're not going to have it. And 30% is a reasonably high alternative scenario for where we are now.
So all the way back to 1987, I think it was after the stock market crash and Greenspan reduced rates, the market started to refer to the Greenspan put, which is in effect that if the markets got into trouble, the central bank would come to their defense. That phrasing kind of morphed into the Fed put. I know you wrote recently that, given where we are now, the Fed put is probably gone. And then you kind of introduced the concept of the CFO put.
Right.
And I don't know if you want to explain to our audience what you meant by this might be a potential dampening of any downturns.
Yeah, I think the way I wrote it up, as I said, the Fed put is kaput.
Yes.
And it's probably been replaced by the CFO put. And the idea is that there's a lot of liquidity in the system that's been left over from the past 2 years of ultra easy monetary policy stimulus and fiscal stimulus. If you look at a chart of M2 and compare it to where M2 might have been if you just extrapolate the trend prior to the pandemic in M2, the difference is about $3 trillion. I mean, it's a lot. Just seems like there's a lot of liquidity still in the system. And a lot of that is in corporate balance sheets. They're sitting on a lot of cash. Corporate cash flow continues to be at an all-time record high. And so CFOs, corporate managements are in a position to continue to buy back their shares, issue dividend, and engage in mergers and acquisitions that I think will continue to be a plus for the market, offsetting some of the tightening that's occurring. But again, it's sort of a tug of war. And I think that's what we're seeing in this volatility in the market that started out the year with a sell-off. Then we saw the market come back in recent days. I mean, all in all, for all the concerns that are out there, we're not that far off the all-time record high for the market. And so I'm encouraged by the resilience of the market, but obviously we'd much rather have the market trend without volatility, and the volatility is going to be something we have to kind of deal with for the next few months.
Yeah, and so talking about that's actually a good segue to, I know you had mentioned that you consider equities a hedge against inflation, and you explained those reasons. And I know you favor equity over bonds. And in a recent piece you wrote about the bond delusion, referencing the bond market, thinking that the Fed was their BFF, and maybe they bought in a little too readily that inflation was transitory. Did you want to talk a little bit about that? I also was hoping you would mention, I know you had also mentioned that as part of your broader equity outlook, there was some reason to favor SMID or small mid-cap names.
Yeah, well, look, the Fed clearly has taken a more aggressive stand, and that's had an impact on the bond market. I mean, the bond market's finally behaving the way I thought it was going to behave last year. Inflation started to really pick up in March of last year, and by February of this year, in other words, it went back over the Fed's target of 2%. Let's use the CPI. Everybody's familiar with that concept. CPI got to 7.9% on a year-over-year basis by February of this year. So we've had basically a year of nothing but accelerating inflation, and yet the bond yield stayed remarkably low. Last year, we started out the year around 1%, and it started going in the right direction for my forecast, which is 1.7% by March of last year. But then it kind of started coming back down to 1.1%. Maybe it was the Delta variant and then the Omicron variant, whatever. It just wasn't behaving the way you would think with inflation picking up. I think with the benefit of hindsight, the obvious story was that the Fed was buying $120 billion per month in treasuries and mortgage-backed securities, and that was keeping things down. I have a chart that I like to look at that looks at the 10-year bond yield versus the ratio of the copper price to the gold price using nearby futures prices. And it tends to be a pretty good indicator of where the bond market should be. And it was saying since the middle of last year that it should be around 2.5%. And I think we got almost, we were still below 2% at the end of last year. And then we started out this year and suddenly we're moving to 2, and now we're at 2.5 and now 2.6%. So the bond market is making more sense to me relative to the inflation outlook, relative to the fact that the Fed in March stopped QE forever, as I called it, and anticipating that there's going to be more aggressive Fed tightening. At this point, that's not much of a call to say that it could get to 3%. It's not that far off. Now I'm working on whether it could get to 3 to 4%, and I can't dismiss that, but 3% is, over the past few years, has been a pretty good opportunity to buy the bonds. So we're getting close, but I still think there's some capital losses in the bond market. Last year was a record year for inflows into bond mutual funds and bond ETFs. So I know people have talked about TINA. There is no alternative to stocks, but last year, I think a lot of people actually rebalanced their portfolios on a regular basis out of their wins in stocks and decided to put some of it in bonds. And now, obviously, they're not too happy with that decision. And as a result, I think that continues to favor the stock market. But we're probably getting closer and closer to the high in the bond yield. I know that some people were looking at the yield curve as an indication and they were focusing on the 10-year, 2-year spread and noting that it inverted a couple of days ago. And then Lael Brainard, the governor of the Fed, gave her hawkish speech yesterday, and there were more hawkish talk today from Fed officials. And suddenly the 10 years back above the 2-year. So it just shows that the Fed has really been, how should I put it, rigging the fixed income markets. We can't ignore the fact that, these markets are not exactly free to give us a good clean signal. But factoring that in, it's clear the bond market is now reflecting a more concern about inflation and more concern about higher interest rates. With regards to the mid caps, I look at valuation multiples. We all look at valuation multiples. We tend to focus on forward PEs. So we look at what analysts are thinking earnings are going to do over the next 52 weeks. There is no such thing. If you ask an analyst, what do you think earnings will be the next 52 weeks? They'll look at you funny and say, I do annual, I do quarterly, I don't do 52 weeks ahead. So there's a proxy for that called forward earnings. And it's kind of a time-weighted average of analyst consensus expectations for this year and next year. And then that number, by the way, is at an all-time record high, which is very impressive. Analysts obviously didn't get the recession memo, didn't get the geopolitical memo. They're just focusing on what they're seeing for their companies. And not only are they seeing that their companies are still having a decent businesses, but they're also seeing that their pricing is going up. So all that is being reflected in better earnings. Now, when we look at the PE multiples, we find that the S&P 500 is still pretty rich. It had been as high as 19 to 20 a few days ago. It had been higher than that last year, so it was kind of coming back to something a little bit more realistic. But if you take out the 8 biggest market cap names in the stock market, I call them the mega cap 8, the PE, the forward PE for the S&P is more like 17. If you want something a lot cheaper, it's the SMID caps. The SMID caps have been trading at 13, 14. They're down substantially from the beginning of last year. And they're not down because their stock prices have cratered. They're down because their earnings have been stronger than for the S&P 500, but they've gotten like Rodney Dangerfield, the comedian, no respect. And we've seen their PEs coming down. So if you're looking for cheap stocks, they're definitely in the SMID cap area. But in this environment that goes from risk on to risk off almost on a daily basis, you have to be prepared for even more volatility in that area of the marketplace. But I think longer term, there's very good opportunities in that regard.
And the three sectors, I think, if I remember you reading, you favored, it was tech, energy, and the financials.
Yeah, or EFT, let's do it that way. I think energy is a very good hedge against inflation. Let's face it. I mean, the reality is the fossil fuel energy sector has been beat up pretty hard by climate activists, and the climate activists have been actually pretty successful in reining in some of their activities. And I think the fossil fuel managements have gotten the message that nobody wants to play with them, or the politicians don't want to play with them, and they're trying to put them out of business. So their attitude is fine. If that's the way you feel about it, we will cut our capital spending. We won't explore for more oil. We won't get more oil. We'll just, pump whatever we have right now. And the result has been higher prices, which is good for their revenues, at the same time that their costs are being cut back because they're not spending as much if they were more optimistic about the future. And so their profits are great, their earnings are great, and the politicians are attacking them, which is an indication of just how profitable they really are. But it's still a relatively small portion of the market cap of the S&P 500 here in the US. And so I think there's still opportunities in that sector for it to do better. I don't think the price of oil is going to go to 150 or 200. I think we may very well be seeing a top for a while here around 100. There's oil out there, and I think at these kind of prices, you'll see more of it coming out. With regards to financials are a good hedge against rising interest rates. That seems to be an on-again, off-again kind of trading relationship. For a while there, we were saying every time the bond yield will go up, financials do well. And then more recently, bond yields have gone up and everything's not done so well. So I think investors are a little bit trying to figure out how this all plays out. But look, as long as we don't have a recession, which again is a higher risk, but it's not the most likely scenario, I think that loan demand is going to be there. I think competitive pressures are going to lead to more M&A. I'm a big fan of Fintech. Technologies being incorporated in a very real way into the financial sector. So in some ways, I view financial stocks as actually being comparable to technology stocks to the extent that they're using technology to increase their productivity. It's a good thing. And so the only problem is, when my kids need money, there's no delay. They get it immediately with Venmo. So it comes out of my checking account, at the speed of light. And then with the technology, again, I think technology is not just the traditional technology. It's fintech, it's medtech. It's wherever technology is being applied that I think is going to be a big beneficiary in terms of earnings and productivity. I guess I had a happy childhood, so I tend to be an optimist. And right now, things look pretty miserable. It's kind of more reminiscent of the great inflation of the 1970s than any sort of happy environment. But I really think that by the end of this decade, we'll be looking back and we can have a little discussion. It's like, so what was it? Was it the great inflation 2.0, or was it the roaring 2020s? And I think it's going to turn out to be the roaring 2020s. One of the reasons for that is there's chronic labor shortages everywhere. And right now that means higher wages. But I think companies are scrambling to increase productivity using technology. And that's at some point going to lead to lower inflation, and it will allow wages to rise faster than prices. It'll be good for corporate profitability and corporate profit margins. So I can see this segueing to a much more optimistic and happy outlook than the one that we're looking at right now.
So that's actually a good segue to monetary policy.
Sure.
I mean, right now is somewhat unprecedented insofar as we have these two, you've very, very low interest rates, and Fed balance sheets are extremely high, and the Fed is trying to normalize or embarking on a normalization of both at the same time. And one thing I wanted to ask you about is, if you go back to, say, early 2018, and monetary policy started to normalize, and the Fed focused primarily on the Fed funds rate and not so much QE, it ended up that by the end of the year, at least using the 2 and 10, which I know is not the best yield curve, the yield curve briefly inverted and the financials and everything fell quite a bit. Do you think this time around the Fed is, I don't want to say viewing that as a mistake, but that the 2018 experience is informing their approach going forward, and they're trying to normalize both at the same time, and at least in part, and I don't know if you think that it should give investors maybe more optimism because there's a learning effect to it, or more pessimism or more concern because that just doubles the complexity of the normalization?
Well, yeah, honestly, I think it's double the complexity. I wish they would hold off on running off the balance sheet and just focus on the Fed funds rate. Get the Fed funds rate up to 2.5%. Leave the balance sheet alone. Don't walk and chew gum at the same time. Just focus on that, and then let things settle down and let the balance sheet start to run off. I think that's actually what's keeps spooking the market here. Is like on January 5th of this year, the FOMC released its December minutes, and in there it said we're going to raise interest rates. Not a surprise. We're going to stop buying Treasury and mortgage-backed securities. Not a surprise, and not a surprise that those things were going to happen in March. But they talked a lot about running off the balance sheet, and I think that got everybody concerned, because I don't think anybody really has a good handle on what that will do to the financial markets. I think we know that, if there's going to be more supply that the Treasury market has to absorb, it's got to put upward pressure in the bond market. But I think people were kind of doing a fast calculation and say, well, wait a second, if they're going to let the balance sheet run off, there's about $1 trillion in treasuries that are maturing on the Fed's balance sheet in the next year. That's about $95 billion per month that the Treasury market's going to have to absorb if they're going to let that stuff run off. And on top of that, they had $120 billion in treasuries and mortgage-backed securities. 80 billion of that was treasuries that they were no longer going to buy. So that's a large chunk of change that the Treasury market will have to absorb. And I think the same thing just happened yesterday when Lael Brainard said, oh, by the way, not only are we going to be more aggressive in raising interest rates, again, that was not a surprise. The big surprise with Lael Brainard is she's a dove, and she came across sounding extremely hawkish. But the other thing was talking about exactly what you said, that they're actually going to let the runoff occur, and she said faster than the last time they tried to taper. Last time they tried to taper the balance sheet, it didn't last very long because they backed off on a tapering tantrum. But I think that's where the Fed policy mistake could lie. But look, nothing is permanent here. They could change their mind. They could conclude that, well, maybe we've done enough. I really think that now that the Fed is so hawkish, my contra instincts are coming out and saying it's probably not going to be as bad as they're letting on or anticipate, or getting the market worked up. I suspect that we are going to see some moderation in the inflation rate, and I think it's that turning point at which inflation clearly looks like it's peaked, that the markets start to anticipate that the worst is over, and that could very well occur later this year, which then would coincide with the midterm elections, which tend to be bullish for the stock market. So. On days when things look terrible, just keep in mind this is probably just the kind of volatility that it's the price we pay for having so much fun for so long and making so much money in these markets. Nothing is easy forever, and this I have to say is a tough year.
Yeah. So one point that you've made many times, which is the inversion of the yield curve, if it happens, isn't the cause of recessions.
Correct.
Credit crunches are the cause of recessions. And so presumably that would, there'd have to be some indicator or some sort of asset class that might be, overvalued or speculative, and there might be some sort of bubble bursting or something like that. And there doesn't seem to be any obvious candidates. Is that a fair comment and forming a view on?
When I look at the yield curve, I tend to look at the 10-year versus the Fed funds rate. Why do I do that? Well, that happens to be the official yield curve spread. What do I mean by that? Well, the conference board took over the job of calculating the index of leading economic indicators in the US. I believe they've got an index for Canada and for other countries as well. You just go on their website. And when you look at the index of economic indicators, guess what? It's got 10 components, and just one of them is the yield curve spread. Right. And we're all like focused on the yield curve spread. Not only that, but we're focusing not on the one that's in the index of leading indicators. We're looking for trouble, and we found it in the 10-2 until the past couple of days when Brainerd said, "Oh, by the way, we're going to reduce our balance sheet more aggressively," and the bond yield suddenly jumped above the 2-year. So this shows that the Fed can still influence the shape of the yield curve. And if the yield curve was really that concerned about a recession, I would think that what a dove like Brainerd turning hawkish would definitely send out a recession message, and the bond yield should have actually gone down on that. Anyways, you can really kind of go all kinds of ways with this. The index of leading indicators happens to be at an all-time record high. Nobody seems to appreciate the initial unemployment claims is one of the 10 components of the index leading economic indicators, and it's at a new, it's near its previous all-time lows. So the labor market is tight as it could be. If you're looking for trouble in leading indicators, I think I'm more concerned actually about the consumer sentiment numbers, which have been very depressed because they've been depressed by inflation. And so the consumer is clearly the driver of the economy. And we know that if they're not happy, they could always kind of cut back on spending. Then again, I suspect Americans and Canadians are kind of similar. When we're happy, we go shopping, and when we're depressed, we buy even more. Right. So you never want to give up on the consumer when they're still getting plenty of jobs. And while wages are barely rising faster than prices, real wages are still going up. But to the point that we were talking about, the yield curve has a history of apparently predicting recessions, but it doesn't cause recession. So what's it doing exactly? I think what the yield curve really does is that when the Fed is tightening, at some point, the yield curve, the 10-year really, starts to signal, you know what, no mas. If you do any more, something's going to break. There's going to be a financial crisis. We don't know what it is, but so many people kind of bet on how low interest rates were before, and now you're kind of shocking the system. And sure enough, something breaks. You get a financial crisis, which then becomes an economy-wide credit crunch where even good borrowers can't raise money, and that becomes a recession. So why is that? Why am I going through this gymnastics in discussing the yield curve and recession? And because I'm looking around for a credit crunch. Is there a credit crunch out there that's going to cause a recession? I mean, is it a Russian ruble crisis? I kind of doubt that. The housing market, there's almost no adjustable rate mortgages that have been made in recent years. So it's just kind of hard to see where things are going to blow up in the credit system. Now you could look at other relationships to worry, like spikes in oil prices have had a correlation with the recessions, but they haven't necessarily caused recessions, and I kind of doubt that this spike is actually going to cause a recession here. So I look at the 10-year and the Fed funds rate, and I see that it's actually been widening, whereas the 10-2 has been narrowing, inverting for a few days, a day or two, and then suddenly it's back up above zero. I also prefer the Fed apparently has a couple of staff members that wrote did some research on the yield curve, and Fed Chair Jerome Powell mentioned the research a couple of weeks ago when he did a Q&A, and that research said basically don't even pay attention to the yield curve, just pay attention to the spread between the 3-month Treasury and the 3-month forward yield 18 months from now. So I've had some email conversations with one of the authors of this research, and I said, I put your data on a chart, and it looks like a spitting image to me of the spread between the 2-year and the Fed funds rate. So I don't really have to do all that work to calculate
Right.
the forward yield. And I think you can, the bottom line is you can really look at the 2-year as a really good leading indicator of what the market thinks the Fed funds rate is going to be a year from now. It just works. Look at it on a chart. And that means that the 2 years at 2.5% right now, that's probably where the Fed funds is going to be a year from now. I'm watching it like a hawk. If it keeps going up, then it tells me that the market still thinks that inflation isn't, it's going to take a lot more rate hikes, and we're not yet getting a recession. When it starts to roll over, that would be a pretty good leading indicator that the Fed may be very close to being done.
Right. Which actually, and so if we assume or set aside the scenario of a recession and no credit crunch, and maybe this is a good moment to kind of segue to fiscal policy,
Sure.
which is, I think what we've seen in the past couple of years is sort of, I guess, 3 trends as it relates to fiscal policy. The first is, there really has been somewhat of a global shift away from pro-market fiscal policy, i.e., ideologically, governments are shifting left, becoming more interventionist, which tends to dampen GDP growth.
Yeah.
The second thing is we're getting very large deficits, which are starting to lead to structural deficits. And then just a hobby horse of mine, if you will, I would say the third trend, which I think is important, even if it can't be directly related, is just the general decline in the competence of the political class and the people who are legislating and regulating. And you see some crazy people getting nominated for bank regulatory positions, for example. So are you worried that maybe there isn't a recession, but that these sort of fiscal pressures or lack of fiscal discipline, and this is maybe I'm over personalizing it towards Canada, where we have terrible fiscal situation, and that growing deficits will place more pressure on inflation, particularly in the next, say, 6 to 18 months, and or you're going to get anti-growth tax policy, or just anything like that, which might not cause a recession, but might, dampen GDP growth a lot.
Yeah, I think those are all, I share those concerns, and it's something I certainly monitor. Look, I think ever since the pandemic hit, we've basically seen modern monetary theory at work. It's, before the pandemic, it was kind of viewed as a fringe idea. The idea being that governments that print their own currencies can spend with abandon to make all of us happy, make sure everybody's employed, everybody has a good job, everybody has a basic income. I mean, you can do a lot of wonderful things when you endorse this thesis that the government can always pay off its interest payments just by printing more money. Well, what about inflation, you might ask the MMT's millets, and their response was, well, don't worry about it too much, but if it does make an appearance, it's like whack-a-mole. We'll hit it with taxes wherever we see it popping up. Well, easier said than done. Here we've seen inflation making a huge comeback over the past year, and there doesn't seem to be any willingness on the part of fiscal policy to do anything about it. Whereas monetary policy is for the sake of the credibility of the central bankers, they have to address it. But we could have a situation where the fiscal policy makers are stepping on the accelerator, and the monetary policy makers are stepping on the brakes, and cars tend to spin around and eventually land in a ditch. So that is a concern. There is a lack of fiscal discipline. But in the U.S., a Democrat, highly regarded economist, Larry Summers, at the beginning of last year said that the third round of fiscal stimulus would really take a big risk of causing a rebound in inflation. And now he's saying that because the Fed is so far behind the inflation curve, having monetary policy alone try to bring it down could cause a recession. So all those are, he got inflation right, so you can't ignore him on the recession side. Give him credit where credit is due. I can't resist dinging him a little bit by saying that he contributed to the great financial crisis by being against regulating credit derivatives. but hey, nobody's perfect. So I think, yeah, and we've seen, I don't know if when you're talking about kind of crazies being suggested for regulators, I don't know if you're talking about Canada or the U.S., but certainly in the U.S. we've had one or two examples of that. As a matter of fact, for the Fed, a lady who was a former Fed governor, Sarah Eskin, was proposed, and turned out she's just got her just an overly climate activist agenda, and she had some other issues that made her an unacceptable candidate. But you want central bankers to focus on central banking and not get. I mean, there's only so many things they can handle, and they're not doing a very good job with handling inflation and unemployment. So, why do we think that giving them another portfolio of concerns and climate change is they're going to do anything effective without actually creating other problems in the more traditional domains they have? So I think it's a concern, but the bankers are a powerful lobby. They certainly can express their preferences with some clout when it comes to the political class. But I agree with you. The political class seems to be either not as smart as they used to be, and or more corrupt than they used to be. Maybe we just didn't notice it in the past, and it's more noticeable now. But it's definitely a concern for all of us. I think it's contributed to the partisanship that we're seeing everywhere, because politicians who just aren't too bright or corrupt or just don't really understand how the world works promote themselves by creating these divisions among the voters, rather than sort of addressing what the commonality of issues that we all face. So so if you agree with me, you can vote for me for president on.
Well, this is kind of maybe closer to home for Canadians, because we lost all fiscal anchors all the way through the 70s into the early 80s, and notwithstanding some very painful fiscal remedies, the government, or sorry, the bond market essentially revolted somewhere around 1994. And at that point in time, rising interest rates had actually consumed one out of every $3 of revenues and interest expense. So interest rates are very low right now, and all these governments are building up all this debt. To the extent interest rates go up maybe more and faster, at least the Canadian experience from several decades ago or 2 decades ago was that it basically ate the budget, and it created some major fiscal issues. Right. Now, that didn't happen in the US, but it seems like this is something to think about, because the starting point pre-COVID and then adding on to COVID, the debt and deficits, these numbers are much, much bigger than they've ever been. Yeah. And if rates did go up in a disorderly fashion, it seems like it might have an impact on the markets as well as fiscal policy, because it might create more deficits that need some sort of.
Absolutely. I mean, right now, I forget the exact number, but it's, somewhere between $300 and $400 billion is our annual bill for net interest. And I think I've calculated what the implied interest rate is, and I think it's about 1.5% on average. Obviously, that's got only one way to go right now. And it doesn't take much of an interest rate hike to suddenly be looking at 800 billion and then $1 trillion. And as you said, it starts to eat. It just becomes the deficit as that occurs. And so we're now seeing how quickly we're paying the price for modern monetary theory on steroids and speed. Another way to think about modern monetary theory is helicopter money. It turns out that Ben Bernanke, who said that if all else fails, you can always just print money and drop it from helicopters if you want to stimulate an economy and bring some inflation back. Remember, only not too long ago they were trying to get inflation up. Now they're trying to get it down. It turns out that when you send people checks in the mail from the government and accommodate or finance some of that with the easy monetary policy, it works. It works like a charm, but it also leads to a rebound in inflation a lot faster than anyone anticipated. And now it's causing interest rates to go up. Look at the 2-year. I mean, just flying from 0 to 250 basis points in about a year. I mean, it's mind-boggling. And now we're paying the price. We are going to pay the price for that in the deficits. So I guess I hate to depend on luck, but in some ways, let's hope we're kind of lucky on the inflation side, and that some of the inflation issues do in fact moderate on their own. Because the only way the Fed can really bring inflation down is to bring demand down, and if it's hard to fine tune that to bringing it down to a soft landing versus a hard landing. But if by the second half of the year we see some peaking in inflation, and we can get a scenario where the Fed goes to 2.5% on the Fed funds rate, or 2 3/4, 2.5 they figure is the neutral rate. I don't know what the heck that means, but if that's what they want to believe, that's fine. But if it all pans out that way, then we should be able to get through this. And that's kind of I am sort of in the soft landing camp, but I'm nervous about that, quite honestly.
And speaking of luck, or let's say randomness to the market, is geopolitics. One thing I think that's interesting is whenever there's a geopolitical event, if you're on LinkedIn or just reading trading updates and things like that, you're overwhelmed with really geopolitics doesn't affect the market, or it's a buying opportunity in almost every instance. I don't want to say that market commentators trivialize geopolitical events, even if they're terrible, like for example what's going on right now, but they certainly are quick to emphasize that geopolitical events typically have more transient corrections and then can recover from there. If you think about geopolitics, first of all, do you kind of accept that premise that it's really tends to, again, leaving aside the the humanitarian aspect of it and just thinking coldly on the markets, that it tends to just create buying opportunities? And also, are there potential geopolitical effects or events that you think would be the exception? For example, China invading Taiwan. Is there anything that you think in your mind, I really hope that doesn't happen, because that would be the exception to this sort of nominal conventional wisdom or rule, if you will? Yeah,
the short answer is, China attacking Taiwan would be a major concern, because then we're talking about shutting off the semiconductor flows coming out of Taiwan, which is a kind of a monopolist in all sorts of ways. And I think what we've all learned in the past few years is that you don't want to have all your supply chains and go into one far off place and count on it to just be dependable to give you just in time inventories. And so, first there was the Trump trade wars that started to make people understand that geopolitics can have an impact on on your supply chains. Then it was the pandemic. Then it was the Ukraine war, and now it's the sanctions. So you put it all together, it's like it's time to move closer to home with supply chains, and that could be inflationary. I mean, it's going to cost money. On the other hand, it could also be very productive. It could reduce transportation costs. It could do a lot of good things, which is kind of what I'm counting on, that the positives outweigh the negatives of bringing supply chains back home. But we've all seen tables of geopolitical crises and how they have in fact been good buying opportunities. Even the Cuban Missile Crisis, where there was concerns about a nuclear attack from Cuba onto the United States. So that's pretty ugly. And unfortunately, that there's an analogy between that event and what we're seeing now, where people are talking about, is Putin crazy or crazy like a fox? And, how's that all going to play out? I think the Ukraine war has had a very significant, not impact on the stock market, which it did kind of create a buying opportunity, but so far it hasn't played out in a major way as a buying opportunity. But then again, look what it's done to wheat prices, look what it's done to oil prices, palladium prices. So it's definitely had an impact on commodity markets. It's created some financial instability in the nickel market, for example. Maybe the amazing thing is how well we seem to, the financial system must be pretty resilient to be able to withstand. I mean, shutting off a central bank like Russia from its money is an earth-shaking event, and maybe we haven't come even close to seeing all the repercussions of that on the dollar. But yeah, I think the horror in Ukraine is absolutely terrible, and it's not over. But neither is the pandemic, by the way. The Chinese have messed that one up big time, and that's a geopolitical event with also repercussions.
So I think we have 5 minutes to go. So I thought maybe what we would end with is sort of, so the best case scenario in your mind is in terms of the market over the next.
Well, the best case is the best overall case is a soft landing, clearly. I mean, we've had a very strange business cycle this time around. We had a horrible recession in 2020 that lasted all of 2 months. Then we had an amazing V-shaped recovery that nobody believed could happen, but I thought it could, and it did. And so we had a V-shaped recovery that lasted all of 12 months. Then we were in sort of almost an inflationary boom there for a half a year or so. And now all of a sudden, people like myself are talking about stagflationary outlook with slower growth and more inflation. And now everybody's worrying about a recession already that could happen imminently or soon. So there's a lot of those kind of concerns. Compared to that, I think that the happiest scenario, the one that I still think is the most likely one, is in fact that inflation will peak. It won't come down back to 3 to 4%, but the Fed isn't going to do a Volcker 2.0 just to get it down to 2%. They'll settle for 3 to 4% for a while. The economy grows at roughly 2%, and underneath it all, capital spending continues to focus on technology to increase the productivity of the mental and manual productivity of scarce labor, and that underlying it all really leads to a much happier scenario. The worst case scenario is, well, everybody, I mean, it's all over the place. You have a lot of pessimists about the World War III and recessions, and you know, when we got a little bit into an unsustainable situation where inflation doesn't come down and the Fed has to raise interest rates a lot more, and you get a recession and you get this rapidly increasing federal deficit. So, you know, we don't really have any freedom to really do more fiscal stimulus. So things can go badly, but look, I'm sometimes accused of being a perma bull, and I take that as a compliment. I hope on my tombstone it says Ed Yardeni, he was a perma bull, and he was usually right. I mean, bull markets last a lot longer than bear markets, and we usually get, you know, bear markets more often than not turn out to be buying opportunities. You want to raise some cash here, anticipating something like that, either a correction or a bear market. That's fine, but I think the long-term prospects are still quite good.
That's excellent. So, first, I want to say thank you very much on behalf of our enormous audience and my colleagues at the firm. I do want to remind everybody to feel free to go to Yardeni.com and look at the free trial. I can tell you that we have been following Yardeni research for a long time, and the accuracy of the predictions and the quality of the recommendations has been great. And so I'd highly recommend it. And on behalf of everybody at our office and myself, Ed, I want to thank you very much for speaking to us.
Thank you very much. Thank you, everybody.
Hey, everybody, have a great day.